Hi, thanks for tuning in again. If you watched last week's episode where I chatted to Ian Black from Acute Accountants on trust audits, you may recall that Ian raised the issue that as auditors, they are required to qualify a trust audit report if a trust bank account reconciliation is not done by the end of the following month. So today, I want to focus on those humble bank recons and perhaps uncover just why this function has such a bad rep with bookkeepers and unpack how to resolve that. But before we begin, for those of you who have no clue of what a bank recon is, bank reconciliation is the reconciling of transactions recorded by the bank on a bank statement for a bank account and reconciling those to the transactions recorded by the business in the same bank account. Why is that important? Well, because mistakes are made, and the only way to pick them up is to have a record from another source to cross-check. If you think about it, every transaction that a business does, and a law firm is a business, by the way, but more on that in a later podcast, ends up in a flow through the business's bank account, whether that's in the form of a receipt or in the form of a payment. Some of these transactions, data capturers in the business are aware of, like, for example, manual payments that are made from the bank account or manual deposits which they make at a branch. But others they are not aware of. Transactions that are not in the knowledge of the data capturers are electronic deposits which are made to their bank accounts and debit orders which they may know the date that the debit order should run, but with weekends and public holidays it becomes a bit of a guessing game. And of course, charges that are raised by the bank itself, such as transaction fees, service fees, maintenance fees, interest and the like. And because of this, it's important to reconcile the bank account in the business books with the actual money that the bank says is in the bank account. Earlier, I said that mistakes are made. These mistakes can be, although hopefully not too often, made by the bank. They may charge a fee erroneously, for example. And this is also an important reason to reconcile, to keep your bankers on their toes. Every law practice has at least two bank accounts, a business bank account and a trust bank account. But most law firms that operate well are likely to have many more. These may be trust investment accounts, credit card accounts, and call accounts. Hell, I always train legal bookkeepers to even set up their petty cash as a bank account, so that it is easier to reconcile to the cash in the petty cash box. That might be a throwback, though, to the trauma that I suffered reconciling my till at my first part-time job at the tender age of 14 on a supermarket till, where just seeing what the customers were buying and chatting to them absorbed my consciousness, and not the calculation of their change, which eventually got me fired. But in fact, reconciliations of all accounts, generally in most businesses, not just law firms, are completely underperformed. Most of it is not done. But I digress, that's a topic for another day. So back to the bank recons. One of the biggest problems that we've identified that law firms have with bank recons is that they're not done regularly and consistently. They are most often done every couple of months or so, and then at the last minute because someone needs some verified information. Because they're done at the last minute, and usually in a hurry, the margin for human error increases exponentially. Data capture errors account for 100% of the reasons why bank reconciliations don't balance. You can be 100% certain that there is a data capture error, and that is why the reconciliation does not balance. Bookkeepers get tired and frustrated, and they will then spend hours and hours trying to find those differences. I'm sure you realize now this is an extremely inefficient way of working. So let's go back to what I said earlier. Every transaction in any business ultimately flows through the bank accounts. If your law practice is a busy law practice, there are going to be a lot of bank transactions. The risk of processing transactions in volume after an elapse of time also means that bank errors will not get picked up in time, which makes it more difficult to rectify with the bank. Most banks, in fact, will not correct errors after a period of 3 months has elapsed. Some even less, depending on their policies and their agreements with you, their client. So how can this function be improved so that the errors are minimized, if not completely eliminated, and the process of reconciliation does not take hours of a bookkeeper's time? But before I answer that, please join my discussion groups on LinkedIn and Facebook. The links are down below. You'll see it in the comment or in the description of the podcast. And subscribe to my channel to get notified when we upload new episodes. It would be lovely to have you to join in on the debates and to discuss these issues. So, how can this function be improved? Well, it's simple really. Firstly, back to my mantra. Every day end is a month end, is a year end. That means that first thing every morning, all the bank transactions from the previous day should be brought into your accounting system. In this way, your books and records are always up to date, and it's easy to reconcile each day to the bank statement, since you're only working with a very small number of transactions to reconcile. Secondly, your practice management software should have a bank statement import function. And better still, have built-in AI to automatically allocate and reconcile transactions, leaving only the anomalies that the bookkeeper will need to deal with. Bookkeepers who have this discipline of bringing in the bank transactions every day and use the AI-enabled bank statement import functionality provided by our practice management system have reported up to a 90% reduction in processing and reconciliation time. That's 90% of their time is freed up. Consider what I said before. Every transaction in the practice flows through the bank accounts. What on earth then do bookkeepers do with all of that free time? Well, that is exactly what you want, a bookkeeper with free time on their hands. If your bookkeeper is a good bookkeeper, they would use the time to do other reconciliations, something I alluded to earlier. Having more time to analyze your accounting records rather than just getting across the line, capturing the transactions, unlocks an ability to evaluate how the practice is doing and where there may be room for improvement, rather than having something bite you when you're not looking. So to sum it up, there's 2 takeaways that I have here for you on bank reconciliations. Do them every day, even if there are 2 or 3 transactions, or at worst, once a week. Secondly, use practice management software that has AI-enabled bank statement import functionality. That's it for this week. Please subscribe to my channel to get notified of new episodes and join the discussion groups on LinkedIn and Facebook. The links are below to debate this and other issues with your peers. Next week, we will focus on billing and how to turn around getting your invoices out faster and getting paid even faster. So till then, be open, be happy, and I'll catch you next week.